Hello there, everyone. My name's Jim Nolan. I'm a customer success advisor here at Novi Labs, and very excited today to have two members from the Novi Intelligence team on the call. We have Brett Sinclair and Brandon Myers here, as well as my counterpart on the customer success team, Jorge, here to answer any questions that may come up towards the end of the call here. So what Brett's going to be running us through today is a slide deck presenting kind of our view on the Permian Basin and its staying power and all of its inventory locations. As I mentioned a little bit ago, we have a lot to get through. It's a very dense subject matter material that Brett's done a great job synthesizing down into these slides here. So we're going to try and roll through, and then towards the end, we have about 25 minutes of content, I think, scheduled. But if you have any questions throughout this meeting, we have a Q&A towards the bottom of the screen. So as the questions come up, feel free to post them in there. Brandon, Jorge, myself, will keep an eye on that. And if we can respond, we will. And if not, we'll defer to Brett until the end of the call here and have him give his insights. Okay, great. With all of the pageantry aside, let's get this awesome presentation underway. Brett, take it away,
Hi,
bro.
everybody. So as Jim said, we're going to be going through the Permian. I will run you through a little bit of the macro setup in the Permian before we get into the more Novi Intelligence flavored look at the inventory. We'll put a summary of this slide deck out for people who subscribe to the free subscription through Novi Intelligence. We'll share a link at the end, and then Novi Intelligence full subscribers will get the entire deck. So going forward into the macro setup of where the Permian sits now. U.S. production is around 13.5 million barrels a day of oil, and about 107 BCF a day of gas. The Permian as a whole, this is inclusive of all Permian production, is just over 6 million barrels a day and 28 BCF a day. So you can see the Permian is almost half of total U.S. oil production and over a quarter now of total U.S. gas production. Oil's on the left there and gas is on the right. As we look at just unconventionals, um, which we look at US lower 48 horizontals, this maps pretty tightly to the EIA's definition of tight oil, tight gas. Um, US total oil production from lower 48 horizontals is around 9 million barrels a day, and total gas production from lower 48 horizontals is around 90 BCF a day. And the Permian right now is sitting just under 6 million barrels and just over 25 BCF a day. So of US lower 48 horizontals, the Permian is now representing about two-thirds of oil production and almost a third of gas production. So the Permian is really, you can see the black lines on the charts. The Permian is really starting to grow, is really growing and been taking market share. Key operators in the basin, there's going to be a little bit of a difference between the Midland and Delaware basins. On the Midland side, you've seen a ton of consolidation over the years, resulting in two behemoths in the basin. ExxonMobil and Diamondback now are the major players in terms of gross operated horizontal oil and gas production. You have oil production on the left. In this page, you have gas production on the right. And just to keep in mind, this is gross operated horizontal production. So we're not netting it down for working interest. We're not netting it down for, we're not including any non-op. This is our estimation of gross production. So you can see that of the top 10 operators here, ExxonMobil and Fang kind of dwarf the rest of the top 10. And when you look at all other operators outside the top 10, they still don't match ExxonMobil and Fang's production levels. As we look at the Delaware Basin, that's a different story. There's been a lot of M&A, A&D in the Delaware Basin, and all the top 10 operators you see here have put their positions together through lots of deals. Even EOG, who's known to be the leaders in the organic development, acquired a lot of their position in 2016 through the Yates deal. So the names you see here represent the top 10 and represent a ton of deals that have been done, but you can see total production is spread amongst the top 10 operators more widely than the Midland, and you can see other operators outside the top 10 dwarf the top, even EOG, the top operator. We've truncated the y-axis here. As we look at where activity in the basin sits right now, the horizontal rig count in the Permian is down about 70% from its cyclical peak at the end of 2022. Um, we're sitting at around 220 rigs right now, total in the Permian, about 55% Delaware and 45% Midland, roughly. The Permian horizontal rig count now makes up about half of total U.S. horizontal rigs. On the frac side, we also see the Permian sitting about half of total U.S. frac crews. Again, the cyclical peak was in 2022 during the price spike, the Russia-Ukraine war. Um, we're at about 80 frac crews now in the Permian, which is down about 60, just over 60% from the cyclical peak. And that's roughly evenly split between the subbasins. We're call it 35 each, Delaware, Midland, with a few in the kind of Permian other category. One thing that one dynamic that we've noticed and that everybody's noticed and commented on in the basin is efficiency gains. However, when we look at drilling efficiency in terms of lateral feet per rig per month, we've seen kind of a couple distinct phases on the rig efficiency side. Up to 2020 COVID, we saw material increases in drilling efficiency. Um, a 23 and 24% CAGR for that period, 2013 to 2020, in both the Midland and Delaware basins. In 2020, it's very interesting, and of course, you would expect to see this. As rig count fell off sharply, the least efficient rigs get laid down first, and you end up with a scenario where only your best rigs and only your best crews are operating. So you see a huge spike in efficiency just coming through COVID and coming out of COVID. You see as rig count increased, the efficiency numbers dropped. And then as rig counts have come off again since the cyclical peak in late 2022, you see efficiency gaining again. So that trend is makes sense. However, since COVID, we are not seeing the drilling efficiency gains overall that we saw pre-COVID. So you can see on the drilling side, there's two distinct periods there, pre-COVID, where massive efficiency gains, post-COVID, minor efficiency gains. On the completion side, when you look at total amount of proppant pumped per frac crew per month, you see this has been more of a kind of a monotonic increase. This data set is a little bit noisy, but the lateral feet are getting turned on. So as you look at the 6-month average, these will kind of cash out into the efficiency metrics you're seeing now on average. The Midland has compounded over the last 4.5 years at about 9% per annum. The Delaware's been a little bit less at about 6% per annum, but we've seen a consistent increase in completion efficiency on both subbasins since 2021. Looking at the completion side in terms of lateral feet brought online per frac crew per month, we see a similar trend as proppant pumped because the proppant loading has been at a fairly consistent level since 2021. And so again, we see maybe slightly more efficiency gains in the Midland than the Delaware, but those are very, very tight. The Midland is now up to about 65,000 lateral feet per month per frac crew getting turned online. The Delaware is just a little behind that at about 55,000 lateral feet per month per frac crew, in the Delaware being brought online. So what does that mean for what we're doing with lateral feet in both basins? So if we look at it from a rig basis, we've lost a lot of rigs, as we described earlier, but we've gained a lot of efficiency, as we've just described. The Midland Basin in 2024 brought online about 32 million lateral feet, with the Delaware Basin at roughly 28 million lateral feet. At current rig counts and current efficiency rates that we just described, that means that in each basin, we would expect to turn online roughly 20% fewer lateral feet per year than 2024's baseline. So if we look at the Midland Basin rigs on the left-hand side, we're roughly 90 right now, and we're between 22,500 and 25,000 lateral feet per rig per month on the rig side. So somewhere between the 17% and the 25% numbers there. So roughly 20% fewer lateral feet per year. And on the Delaware side, we're in the 120 rig ballpark. We're 15 to 16,000 lateral feet per rig per year. So again, right around that minus 20, minus 15, minus 20% lateral feet per year mark relative to 2024 baseline. Now, looking similarly at this number, but from a completion side, so looking at the frac crews that are active right now in each basin and the efficiency of those frac crews at bringing online lateral feet. This implies, again, around 15% fewer lateral feet per year. So there's just relatively more frac crews running than rig crews running in terms of turning on lateral feet. But if we look at the Midland Basin on the left-hand side, we're at around 35 frac spreads right now. We're at around 65-ish thousand lateral feet per month per frac spread. That would imply minus 16% in terms of lateral feet per year relative to 2024's baseline. Going over to the Delaware Basin, again, we're roughly 35 frac spreads. We're at roughly 55,000 lateral feet. So that's minus 17. So again, triangulating this number from the completion crew and the drilling rig side would imply at current rig and frac levels, at current rig and frac efficiencies, we would be turning online roughly 15 to 20% fewer lateral feet per year than 2024's baseline. We show elsewhere in some Novi Intelligence content in our Midland and Delaware Basin reports that productivity per foot has already peaked. So we're not going to make up those losses in lateral feet with incremental productivity. Okay, before we move on to some kind of our bread and butter, some Novi machine learning derived forecasts of inventory, just to break down what we're doing here. So when we train models to predict well performance, all the features you can imagine that describe these wells are going into that. So those are a lot of geological features like, the petrophysical properties, water saturation, porosity, et cetera. There's some mineralogy, there'd be TOC, some geochemical properties, et cetera. Obviously, those matter huge for well performance. Your completion matters for your well performance. How much proppant and fluid are you pumping? How tightly you space those wells to neighboring wells will impact it. And how much fluid or resource has been pulled out of that reservoir before you go in. So our machine learning models train on all these features and then bucket them into four primary categories that we consider rock quality, so the geological variables, the completion score, the well spacing score, and the prior pressure depletion score. So as prior pressure depletion is going to be affected by how tightly you space, but how long after the existing wells are online you go in and develop more wells. The completion and the well spacing are operator decisions, and the geological rock quality is going to basically be set once you have your position set. So starting off right now, we're looking at Midland Basin inventory. We've bucketed all the wells, both drilled and undrilled, together. The top quartile is going to be tier 1, the second quartile tier 2, down to tier 4. On the left, we show the map of what has been drilled already to date. And you can see there's just over around 8,000 wells apiece have been drilled in the top two tiers. Around 5,000 wells apiece-ish have been drilled in the bottom two tiers. And you can see at that map on the left where those wells have been drilled, colored by those rock quality tiers. Moving to the next slide, we see what's remaining. So what's remaining is about 25,000 locations in tier 1 and tier 2 rock, 10,000 each, and well, just over 20,000, and roughly 25,000 in tier 3 and tier 4. And so you can see on this map on the left where those locations are. So the tier 1 and tier 2 are kind of left where you would expect through the core of the Midland. One interesting thing to note here is as you get to the western part of the Midland Basin where the new Barnett play has been getting some attention. You can see that most of that is ranked tier 3 relative to every other well in the Midland Basin. As we look at what's been done in the Midland Basin to date, we can see that tier 1 and tier 2 wells are less than 50% drilled in the basin. And over time, This black line on the right shows the percentage of all horizontals that have been drilled in the Midland over time that are tier one and tier two, so the best rock quality. We can highlight this and we show this in different ways in some of the different Novi intelligence content we put out, but we can see that the price collapse in 2015, 16 led to a high grading of rock quality. Up to 80% of wells are being drilled in the highest rock quality tiers. That falls through the 2016 and 19 period, and peaks again at 80 plus percent coming out of COVID. But it's been falling lately, and we're now sitting between 50 and 60% of wells being drilled in the highest rock quality tiers in the Midland Basin. So we keep moving forward. We're going to look at this, dial it in a little bit more detail down into by formation. These are the top three formations that have been targeted in the Midland Basin. You can see that in the Lower Spraberry Shale, the amount of tier one that's been drilled is up over 2/3. In the Wolfcamp A, it's approaching 60%. So you can see as you get down into the detail, different formations are relatively more or less drilled in the different rock quality tiers. Moving on to the Delaware Basin side, the Delaware Basin came online, really started ramping in the 2016 period after the Midland Basin and after the price war of 2015. And so the Delaware Basin, more than any of the other unconventional basins, has been biased. The historical development has been biased toward the best rock quality. The industry had figured out how to target the best rock quality in these unconventional basins. And so the majority of wells in the Delaware have been put in tier one rock relative to the other tiers and relative to other basins. However, when you look at remaining inventory, while tier one has less remaining inventory than the lower tiers, the Delaware Basin is so pervasive and so extensive, there's tons of tier one and tier two inventory left. We see 16,000 plus sticks in tier one. We see over 20,000 sticks in tier two. So we're looking at 38,000 or so remaining tier one, tier two horizontal locations in the Delaware. And you can see that's heavily biased toward that, northern Reeves County, that Lee County, and some Eddy. This similar chart to the Midland Basin, we can see that tier one locations are less than 50% drilled over here on the left, with the lower tiers even less drilled. And we can see that historically, there was a little bit more bias toward tier one relative to the other tiers. And again, coming out of COVID, we see that really high grading in terms of geological rock quality of 80% of locations being drilled in the tier one, tier two rock. And that's also been falling lately, down to around 60% on average in 2025. Looking at formations, we see a similar trend to the Midland Basin, where in the most drilled formation, which is the Wolfcamp A, tier one has been relatively more drilled. So while tier one rock across the basin is less than 50% drilled, tier one rock in the Wolfcamp A is over 60% drilled. Now, as we consider prior pressure depletion in conjunction with rock quality, we can see the impact that pressure depletion will have on each of the various rock quality tiers. And I should have mentioned earlier, when we bucket our machine learning scores into the various tiers, what I describe is the impact. When I'm describing a rock quality tier, I'm describing the impact to the well's predicted performance only on rock quality, holding all the other variables constant. So what we're looking at on this plot is in each of those rock quality tiers, what would be the predicted impact on well performance, the remaining wells, based on our modeled prior pressure depletion from the existing wells there. So we see Midland on the left, Delaware on the right. The Midland is going to suffer a little bit more from prior to pressure depletion on remaining wells compared to the Delaware. So we see about 44% of tier one rock is going to be hit by 10% pressure depletion. And about a quarter of tier one rock in the Midland is going to see 30% impact from pressure depletion. In the Delaware, that's only about 20% of wells going to be subject to 10% depletion, so less than half of the share of the Midland. And at 30% depletion, less than 5% of tier one wells are subject to 30% depletion. So the Midland will be more affected than the Delaware by prior pressure depletion in terms of in the best rock quality tiers. Now, what does that mean for how long inventory is going to last? So what we've done to forecast this inventory out is we've taken the first half of 2025, how many lateral feet were brought online in each of the rock quality tiers, and we're holding that cadence flat and seeing how long the remaining lateral feet in each of those rock quality tiers will last. So at today's pace, Tier 1 and Tier 2 rock in the Midland Basin on the left are going to last to 2037, 2038 in our model. And you look at the bottom two rock quality tiers, you're well into the mid 2040s before that runs out. The Delaware Basin has been biased more toward Tier 1, but you see the Tier 1 locations are going to last beyond 2037, 2038. And Tier 2 locations at the current cadence are going to last into the 2050s. So you can see that we have over a decade of the highest quality rock remaining in each of the subbasins, each of the Permian subbasins. If you treated the Permian as one basin and you allocated all your H1 2025 activity in terms of the rock quality tiers and held that constant, total Tier 1 rock in the Permian is going to last until about 2037, 2038. Tier 2 rock will last till the mid 2040s, and the lower tiers will last to the late 2040s. What does that mean for each operators? So in this slide, we're looking by the largest operators in the Midland Basin, and the diamonds represent the 2024 cadence in terms of million lateral feet that operator turned online in that basin. The height of the bars represents what that implies for inventory life remaining. We see PR over here at the left is truncated because they just aren't doing a lot with their Midland Basin, the portion they have in the Midland Basin. You'll see them on the Delaware side. You can see here, like we described earlier, Diamondback and Exxon are at 7 million lateral feet per year, way ahead of the rest of the basin. But in terms of all their locations, they still have well over a decade each of locations, or of lateral feet remaining, rock quality tier agnostic. If we look at only Tier 1 and we apply all of their development, so all 7 million feet per year to Tier 1 only, you see Diamondback and Exxon go to, they still have 4 to 5 years of Tier 1 only locations remaining, not including their Tier 2 and after. And that's if every lateral foot they drilled was only in that rock quality tier on the Midland side. Looking at these two charts on the Delaware Basin side, we can see Conoco again has decades of total inventory life remaining at their current cadence, which is relatively low. We see that EOG is the dominant player in the Delaware at 3.3 million lateral feet per year. And interestingly, Mewbourne, the private company, is second place on that metric in terms of cadence. And you can see this inventory length in terms of years, and this is agnostic of rock quality tier, is going to be over 15 years for the majority of these operators. Again, applying all of their development to Tier 1 locations only, you can see a lot of these inventory lives fall down into that 4 to 5 to 6 year range. But again, this is applying all of their lateral feet to Tier 1 only. Finally, what does that mean in terms of remaining economics here? So we're modeling over 130,000 remaining locations, proven locations in the Permian Basin combined. Of these, approximately 37,000, or just over a quarter of these locations, generate an NPV, a positive NPV 25 below 50. So when we look at break even, we're considering at a 25% discount rate, what will generate a positive NPV. Okay, so at $50 a barrel, we have 37,000 locations remaining. At $70 a barrel, over 100,000 locations are remaining. And at $90 a barrel, we have 123,000, or 95% of all Permian locations can generate a NPV 25 break even at $90 a barrel. The median of these 130,000 plus wells is $57 a barrel, and the average is $61 a barrel. So you can see at today's prices, the median and the average well left in the Permian Basin can generate a positive NPV 25 or PV 25 break even. So in summary, um, we show over 130,000 remaining PUD locations, and we have resource locations too that we consider unproven. Not enough data in that bench or in that area to train our models on within a tight range. We have a wide dispersion of results there. So 130,000 proven locations and 70,000 resource locations for 200,000 overall. At today's pace, or at the pace of H1 2025, we expect Tier 1 locations to last to 2037 and Tier 2 to last into the 2040s, or roughly 20 more years. The Midland Basin, if you take something away, the Midland Basin has more pressure depletion risk than the Delaware Basin. Um, Nearly half of remaining Tier 1 locations expect to see a 10% hit from pressure depletion, with a quarter of Tier 1 locations expect to see over a 30% hit from pressure depletion. In the Delaware, this is much less. Only 20% of Tier 1 locations subject to a 10% hit from pressure depletion, and less than 5% impacted by more than 30%. The Midland Basin is much further along the consolidation path, with ExxonMobil and Diamondback having the majority of production, the majority of activity, the majority of remaining locations in the best rock quality tiers. The Delaware Basin, while it's seen a lot of deals lately, relatively more disaggregated, with 10 companies having significantly scaled positions, another bunch of companies after those 10 that aren't as scaled but are significant in their own right. Okay, I think we're running up to the end here. I think we will open it up for questions, Jim, if there's any coming through.
Yes, absolutely. We have a couple in here. So, do we have an uncertainty on those inventory trends? Maybe like a factor
Yeah, so
like that?
we in the Novi Intelligence kind of data download that we provide, we have a P10 P90 ratio
Hmm.
that we apply to each one of these sticks,
Hmm.
right? And so that will kind of give you a range of like a confidence interval of our expectation of the performance from those wells.
Hmm. Thank you. And just kind of let's see, we just had one come in. Someone said that the Permian can't survive at $60 oil rates and will decline. How does that harmonize or clash against your 70K locations remaining?
Yeah, so I think we show, and I showed at the beginning there, that while there's a lot of locations remaining, at today's activity levels, we're looking at about 20% fewer lateral feet per year than was brought online in 2024. We also show that productivity per foot in terms of 12-month cumes per foot and also EUR, 30-year EURs per foot, have already peaked. So even though we have locations that are generating a rate of return, um, operators aren't plowing through them at the fastest rate they possibly can. And
Hmm.
so we're still seeing that they're going to bring on fewer lateral feet, and those lateral feet are going to be less productive than they were previously. So growth has to slow. The next step for us, and you will see this coming down the line, is for us to map these rates of activity to a macro supply picture.
Hmm.
But we should see the Permian continue to take market share from the rest of the U.S. Breakevens are higher across every other unconventional basin than they are in the Permian. So the
Hmm.
Permian will continue to take market share from the rest of the US, but it's going to be difficult to grow um, from here at these activity levels. And operators are rightly prioritizing rates of return to growth.
Hmm.
Brett, I was just going to add to that. So and there's a good caveat. So the break evens that we talked about today are well, a couple things. One, they are more or less half cycle. They to an extent proxy full cycle because we've discounted them at 25%. The caveat here is this: it does assume $1.50 Waha, so this would be more reflective of an operator that does have the ability to get its gas out at a decent price. It's assuming $20 a barrel for NGLs in the aggregate barrel. So those are two caveats. The flip side of this, and when you see those like kind of the claims the Permian can't survive at 60, there is a difference between half cycle wellhead break even and free cash flow break even. And those are very different, right? The companies themselves could very well be struggling at 60, more from a income statement perspective, even though the wells themselves might, technically have a break even that's under 60. So I think that is the discrepancy is, um, what's good for the health of the entire company versus what's the go, no go level on making a wellhead decision.
Thank you very much, Brandon. I think we have time for one more question. We are already over our allotted time, so let's just see. Just a quick one. Why is Delaware less at risk for pressure depletion? Is well spacing larger? What's the insight there?
Yeah, I think the short answer here is this. It is a kind of pseudo physics based calculation that's tied into our ML model.
Mhm.
It is trying to figure out if there's overlap between two wells stimulated reservoir volumes, how much oil and gas and water has been removed between parent and child, and how long has gone, or how much time has passed between parent and child, purely out of the, I guess, magnitude of the Delaware's vertical spacing, just given how thick that stacked pay is. It's getting a little bit less of a hit. That's probably the short answer here. Yeah.
And the only thing to add to that is a little bit, Midland was the first one to be developed. So a lot of operators were developing only one bench. And so all the benches that are above or below can get affected now that they're coming back. In the Delaware, people took a different approach where they were actually developing more of a pad layout and putting wells in multiple benches. So it's a little bit of the learnings that folks had in the Midland that have helped the Delaware to be less affected.
All right, everyone. Well, it looks like we've got something like 20 more questions coming in the chat and the Q&A. We could probably talk all Permian Basin all day, but unfortunately, we have some time constraints here. So what we're going to do is if you have a name attached to your question, we'll do our best to respond back to you. And again, keep an eye out for any communications about this coming from the Novi email address that will follow up with a link to the recording. And as Brett had mentioned, use that sign up link, intelligence.novilabs.com/register. You'll be able to sign up for a free tier and gain access to the summary of this slide deck today. And our paying subscribers will, of course, be able to access the full report here. Okay, everyone. Well, thank you very much for all of your time. Brett, fantastic presentation. Brandon and Jorge, thank you for hopping on and assisting with some of the Q&A. I saw you guys chatting in there too. Very much appreciated. And until next time, everyone, Novi Lab signing off. Have a good one.